Welcome to ETF Edge. It has been a lousy week for Bitcoin ETF believers. SEC Chair Gary Gensler has thrown cold water on the idea he will imminently approve the many Bitcoin ETFs under registration. Joining us to discuss, Dave Laval, Global Head of ETFs at Grayscale Investments. Simeon Hyman is the Global Investment Strategist for ProShares and the man behind the newly launched Bitcoin Strategy Pro Fund. And that's a mutual fund that holds Bitcoin futures. And my old friend Dan Egan, there he is, Managing Director of Behavioral Finance and Investing at Betterment. Dave, let me start with you. Grayscale runs the Bitcoin Trust, obviously the Grayscale Bitcoin Trust. You said you want to convert that fund into an ETF as soon as possible, but handicap this for us. People are trying to figure this out. Gensler has essentially signaled that he's going to support Bitcoin futures ETFs, but not necessarily a pure Bitcoin ETF. Is that your read? And give us your sense of where it's going from here.
Right. Well, we viewed it very favorably at Grayscale because this is no longer a question of, if there's going to be a Bitcoin ETF, but in fact when. And at Grayscale, we've committed to converting GBTC into a Bitcoin ETF when regulators are allowing that. And we view it to be quite favorable. And this is just the beginning of our ETF business, and we think that we're going to be very open to all different types of products with all different underlyings to meet our investors' demands.
Simeon, that was a nice optimistic little spin on things. Eventually, something's going to happen down the road, but I have to say, it's for people who are Bitcoin purists, they consider a Bitcoin futures ETF a bit of a tough sell. Now, you were in the right place at the right time. You launched your mutual fund,
that's right,
Bitcoin futures ETF. Tell us how that works and what you see the prospects, or how do you read against?
We were really happy to launch the first Bitcoin futures mutual fund. And that's a really important access point for folks. Number one, the futures have the advantage of being a regulated place. It's the CME, CFTC, the clearinghouse. And this is the only avenue for an open-ended mutual fund where you can get in and out every day at NAV. So that's, we think, a real move forward for opportunities for people who maybe wanted this kind of more common and more usual type of exposure that people are familiar with from other parts of the market.
Yeah. Now, the complaints about the futures, people who use futures contracts for proxies for the underlying here. About the complaints about the rollover cost, the high rollover cost. Can you tell us a little bit about what you anticipate the rollover cost? Because you're going to be buying near front month future contracts. You're going to have a rollover cost. How is that going to impact how you price this? And do you anticipate your Bitcoin futures mutual fund or ETF will in any way approximate how Bitcoin trades?
So the thing we know from history is that those front month futures contracts are extremely highly correlated to the tune of about 0.9, both correlation and volatility with spot Bitcoin. We don't really know what roll costs will ultimately be. It's been a very volatile asset class, in fact, going straight up for much of the last couple of years of history. But of course, they're costs in any way that you would get exposure to Bitcoin, whether it's spreads in the spot market, whether it's OTC trading of various vehicles. So there are going to be a lot of ways for people to get exposure here with some pluses and minuses, but we certainly think that the regulated future space in a regulated mutual fund and an ETF, if it's ever allowed, is certainly a way that some people will really appreciate.
Dan, let me bring you in. Betterment is a big financial advisory firm, a robo-advisory firm as well. How are Betterment clients reacting to this recent rally, the 50% rally in Bitcoin in the last month? And what, if any, advice do you give them about investing in crypto as the behavioral expert?
I got to say, right now, the silence is deafening. Back in 2017, we spent a lot of time trying to listen to our customers, and we have multiple channels that they can speak to us through where they can annotate what they're doing with their money. And back in 2017, when it was the first time that Bitcoin was really peaking, we saw a lot. We saw a lot of messages, a lot of questions, a lot of, actually, I might move my money out to go over to this new thing. In contrast to that, we're not seeing anything. So I think the volatility is good, but I think in order to see significant inbound interest, in order to see people really moving money, especially on the individual investor side, we need to see it break new highs. For those sort of like attention-grabbing meme stock type assets, just moving around isn't enough. It actually needs to be the one thing that's moving the most to be able to garner all the attention to get people to pile into it. So as of yet, it hasn't hit new highs. We're not seeing too many people talking about it.
Yeah. Well, look, Dave, what does it take? What's it going to take This is the topic of the
Right.
du jour. I hate to keep hitting on it,
No,
but
no.
what's it going to take for Gensler to approve a pure Bitcoin ETF? He seems to be signaling, as Simeon said, I'm sorry, Bitcoin futures is a regulated market. Currently, I don't have any control over a good aspect of the Bitcoin market, and therefore I've got problems. What is it going to take for Gensler to get to say yes on a pure Bitcoin product?
For 25 years, we've been innovating in the ETF market, and so the SEC is always going to say it's about investor protection, which it is. But when SPY came to market, right, it was novel, it was innovative, but it was a market cap weighted US equity-based product. It's now $385 billion. But throughout the history of ETFs, each step of evolution, whether it was international equities, commodities, futures-based products, fixed income, subsectors of fixed income, the same process has happened. And really, at the end of the day, to get into a little bit technical, it's ensuring that there isn't going to be a dislocation in the secondary market trading of that ETF, right? That the price is trading versus that underlying price. And so, when the SEC gets comfortable that there's enough transparency and enough maturity in the underlying market, we're going to see an ETF.
Other than someday this will happen, Simeon, is what needs to happen at this point? What does Gensler need to have to say, I'm comfortable now going ahead of Bitcoin ETF?
Yeah, I'll demur from kind of trying to forecast what the
on this
SEC.
one.
We were passing a little bit, but I think Dave's point is a good one. Look, this will evolve. We are in the early innings. The underlying use cases of DeFi and the ledger and anonymity, those things, and concerns over an environment of very low interest rates and possibly weakening central bank currencies, those are all things that drive the underlying value. Yeah. There will be a myriad of ways for folks to get exposure over time. Futures-based mutual fund, that's allowed today. Futures-based ETF might be allowed tomorrow. Spot ETF, perhaps sometime in the future. We're all watching it, and we're watching it. And when those opportunities avail themselves, we'll be exploring them very carefully.
Dan, does Betterment have a dog in this race? I mean, how does you feel, or how does the community there feel about what they want to invest in?
I got to say, an ETF would make it a lot easier just because it's going to be exchange traded, a lot more transparent, and it obviously solves the custody issues. From a magnitude point of view, though, it's not that big. I do think that a little bit of cryptocurrency, for any kind of speculative asset, whatever it is, goes a long way. You do not need a lot in your portfolio, either from a volatility angle or from a sort of speculative angle. A little bit goes a long way. So generally, when people ask us, we're going to say, definitely sub 10%, generally between 3 and 5% is plenty. You just got to make sure that's money that if it comes down to it, you can afford to lose because it is very volatile. So watch out. The last thing, if it is a speculative investment that I think a lot of people don't think about, buying is easy, knowing when to sell is hard. So when you get in, start thinking ahead of time about what are my exit criteria here? When is it going to make sense for me to get out of it?
Yeah, my old friend Rick Edelman, 5-6 years ago, when I asked him, what are you telling the #1 RIA in the country? He said, Bob, there's a very simple way to look at this. Try having it as 1% of your portfolio. It's not going to matter that much if it drops, but it has the potential to double, triple, and then all of a sudden, instead of 1% of your portfolio, it's 3 or 4 or 5%. That made some eminent sense to me, that if you didn't want to completely stay away from it, but didn't want to go all in, the 1% hypothesis, and Dan was sort of alluding to that in a way, made a lot of sense to me. Let me ask you about Gensler's comments. He seems to be indicating he's going to be more aggressive on enforcement. Mm-hmm. He said he's seeking additional authority from Congress to prevent transactions, I'm really reading from a statement here, products and platforms from falling between regulatory cracks. And he seems to be raising the prospect of even more enforcement efforts here, particularly maybe even on ICOs. I wonder if this is going to give any more pause to the Bitcoin community at all.
So I would say, look, I'm a week and a half into my Bitcoin, being at Grayscale, my Bitcoin experience. So I got a little more time to learn about that before I comment with more clarity. But we're certainly paying very close attention to that, as we are with the rest of the congressional commentary around cryptocurrencies. And
he mentioned the tokens. He didn't make a ruling on anything, but he said, they seem like investment contracts to me. If you offer them, it's that old Howey test. If you give some guy money and you're anticipating making money, that's an investment contract. That falls under the SEC. He seems to be, and I'm reading between the cracks, but I don't think I'm crazy, that they're almost all investment contracts and should fall under the purview, implying that a lot of people are unregistered. out there. There's unregistered securities out there.
Well, all of these pieces of the crypto world have different uses. Bitcoin is not the same as Ethereum. And we're in such the early innings that there are going to be evolutions of usage. There are going to be evolutions of regulation. Those are all going to be facts of where we are in this nascent business, but it's not going away. And investors are going to want multiple ways to get that exposure, because you may need that exposure to to spot Bitcoin. You may need your own wallet. You may need your private key, or you may just want a 1% allocation in a portfolio for diversification, digital gold, alternative to currency, in which case something like a futures-based mutual fund or an ETF might be a great solution for you.
You made a good point, Simeon, that people might want Bitcoin in a lot of different ways. Grayscale Bitcoin Trust has been very successful.
Sure.
I find that people are a little confused about what it is.
Right.
Maybe you could take 30 seconds, and I know this is a primer, but people need to understand what it is. It's not a mutual fund. It's not really a closed-end fund either, though some people think it is because you own a set number of Bitcoin. What is it exactly?
So there's an evolution to the products that we have brought out, starting with the Grayscale Bitcoin Trust. It starts as a private placement, then it moves to be a public quotation, and now it's an SEC reporting company, hopefully with the goal of becoming an ETF. But it's traded on OTCBB. There's a lot of
over the counter.
Over the counter. It's traded over the counter. There's a lot of talk about it trading at a discount, and we've been on the record, and I continue to say that typically something trading at a discount can be a buying opportunity. And if we do have the ability to have regulatory approval to launch an ETF, that discount should collapse.
Yeah. So it's people somehow think it's a closed-end fund. It's not technically a closed-end fund at all, even though you own a set number of Bitcoin. This is where the confusion comes in. I don't want to get too far into the weeds, but it's a grant or trust, I think is the technical word.
I think people make that distinction that it trades like a closed-end fund because of the premium and discount characteristic to it.
And it did trade at a premium up until February or so, and then we started trading at a discount.
Yeah, traded at even a steeper discount, and now it's rebounded significantly.
Yeah. And the initial Bitcoin holding, you have what, 650,000? It's somewhere around there, right?
Correct.
Right now. Right.
Correct.
And is it still fair to say that roughly 1,000, is that the normal ratio to a Bitcoin?
So it's roughly 1,000 shares to one Bitcoin.
Yeah. I always like to say there's 10 shares of the GLD, you get gold.
Right.
And roughly 1,000 here you get. I know you could trade the discounts and everything, but that's a rough estimate, right?
Rough estimate.
That's a fair estimate. Okay. Dan, tell us a little bit about how Betterment customers are interacting with meme stocks. I want to just move off of this just a little bit. Obviously, Robinhood has been in the news recently, but even going back to GameStop, what do you tell people about that involvement? Because now you have stocks that are obviously trading for people who are, let's say, fundamentally insensitive. I don't know what the word should be. But how do you advise people when stocks start trading at prices that are completely divorced from fundamentals?
One of the sort of key things about meme stocks that we see is that they kind of need to have a community focusing their attention on just that one thing. It's not a matter of being diversified. Everybody needs to focus on GME or a silver ETF, whatever it is, especially if they're trying to do short squeezes. So I think there's some level of, we have to be realistic. People like to enjoy investing. There's some level of gambling tendency in it. And that's okay as long as you keep it kind of under control. As long as you say, I'm going to treat this like Vegas. I'm taking money out. I'm not allowed to take out more than I've taken with me. I'm going to have a sort of set risk budget for it. And as you said, if I make huge returns, great. I should rebalance back out of my speculation pot into my serious retirement goals, etc. That's a little bit what I think we're starting to see over at Betterment, which is that we're over a year now on from the trough, the 2020 March trough, where a lot of people started speculatively trading, looking at individual things. So we've moved out of that kind of like initial novelty area. Now people are a little bit like, you know what, this feels like a job. I've got to manage assets. I've got to look for buys and sells. I probably have an Excel spreadsheet somewhere. So we're starting to see what I would call day trader fatigue, or people saying, you know what, the novelty is worn off, and I want somebody who's going to do this for me. So we're still actually seeing pretty good inflows from new customers and new signups as well.
Yeah, this is a story that's been around for 25 years. Even Jack Bogle, who's probably the person who most influenced the way I look at the world, the founder of Vanguard, admitted that people like to gamble a little bit, and he himself said, if you feel the need to scratch that itch, take a small amount. He might have mentioned 10%, but that seems to be where a lot of financial professionals are gravitating around. If you really feel the need to gamble, you should have most of your money in long-term, passively managed funds. Most people feel, but take 10%. Dan, does that 10% number mean something a lot to you? What I find interesting is exactly what you said, that it's very easy to get in, but devising an exit strategy is very, very difficult. Market timing is extraordinarily hard to do, and generally you lose for the simple reason that you got to be right going in and you got to be right going out. So we all know this, and you've been talking about it for many, many years. And the academic literature is overwhelming that market timing does not work over long periods of time. So do you think, I like that line you used, investor fatigue. Is that starting to get through to the new investors that are out there?
Yeah, I think we're seeing something kind of interesting. So, if you think about life cycles of people, young people, like 16 is when you learn to drive a car or something. And I don't know, maybe like 30 is when you buy your first house. What we saw is the pandemic in 2020 kind of smushed a whole generation of people into learning about investing in the same time, namely about April, May of 2020. And the academic literature says this often happens. People come in, they want to get their hands dirty, they want to learn about investing, and they do it. They manage their own portfolio in stocks that they're familiar with, retail name, consumer-focused names, things that make them feel comfortable with getting invested. After they do that for about a year to 2 years, they start to learn that, day trading is work. It takes attention. Sometimes it's stressful. And I don't know that I want to do it anymore. So you generally see this sort of fatigue kick in somewhere between a year and 3 years, with people realizing that, number one, they're not beating the market by that much. And number two, it's a job and they don't want to have a spare job.
Yeah. One of the things that amazes me, Dan, is the old Wall Street. I've been 31 years at CNBC. I'm down here at the New York Stock Exchange 24 years. Old Wall Street tends to poo-poo the Reddit traders and the Robinhood crowd. And I do not understand that attitude at all. To me, I look at Robinhood, I see 22 million accounts in a few years. That's an amazing number, 22 million. Schwab has 33, 34 million. Vanguard probably has 37 or 38, and BlackRock probably the same number. But they've been around for decades. 22 million accounts in a few years. Now Wall Street says, oh, but there's not much money in the accounts. And I say, that's not a good attitude. Those people are going to grow, and what you want to do is encourage them to stick around and educate them. So, what you're saying, Dan, makes an awful lot of sense to me. I just hope that they stay around, because there's going to be a downturn at some point. They're going to lose money. So will they just throw up their hands and say, oh, it's all rigged, Wall Street's rigged? But it's not rigged. It's just the market turned down. And hopefully they'll stay around. So I'm cheering for Robinhood. I really want those 22 million, not for the company, but those new investors. I want them around. They're a really valuable source of energy for the market. So Dan, I hope you're going to be able to be a factor in making those people stick around.
We'll take them and upgrade them.
Yeah, okay, very good. Guys, I want to thank you for joining us. It's been a fascinating discussion. I had to make a little veer off into Robinhood because Dan and I talk about this for many, many years here. That's it for this week's ETF Edge. My thanks to Dave, Simeon, and Dan. We've asked Simeon to stick around and talk a bit more about ProShares ETF products. Remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.